Right, thanks for coming on, Narciso. I'm joined by the providers behind Darwin ZVQ and a few others, I believe, that I'll let Narciso introduce them. Thanks for your time, Narciso. Great to have you on board. How you doing?
Hi, man. How you doing?
Good, thanks. Yes, getting through our newly found dynamics in the world with COVID and remote working and interesting dynamics thereabouts. How about you guys?
Same thing, man. Just getting used to it. Hopefully, at some point we will. So yeah. But anyway, it's better when it's raining like today.
What I wanted to do today was essentially go through and introduce you firstly as the providers behind Darwin ZBQ, and you can introduce any other Darwins you have alongside ZBQ. And I wanted to generally just keep it a casual conversation whereby, you get to introduce yourself, we get to converse a bit about your process, what goes on behind the scenes with ZBQ and other Darwins that you host, and just take it from there essentially. So firstly, it'd be great if you could introduce yourself to the audience. All of us can get to know a bit more about you, about your background, your engagements, etc., and we'll carry forwards from there.
So basically, we come from institutional background. I mean, we've been working for institutions, one of the main institutions over here in Spain and abroad.
Mm-hmm.
And creating products from the institutional point of view. So funds, hedge funds, leverage, non-leverage, I mean,
Mm-hmm.
different vehicles, onshore, offshore, I mean, all sorts. So we've done any kind of sophisticated stuff in the institutional world in which we manage over 2 billion in total, 3 billion for different institutions. But as a company just for alpha, like we're talking about for these strategies that we have running in Darwinex, the track record started in 2008.
Mm-hmm.
We're running one of the biggest hedge funds in Spain with almost $190 million. That one.
Mm-hmm.
So basically,
That's impressive.
it's institutional quant trading, applying the latest techniques available at the time. And the idea with the Darwinex is to change the focus because 2 or 3 years ago we decided to pivot the company from being a regulated company to a non-regulated. Right now we're not regulated after a few years being a regulated entity because we want to, let's say, we're focused on the, let's say, you want to call it fintech approach. So the idea is to create what we call a quant advisor, which is a mixture between institutional track record and background together with the latest technology and a fintech approach. So that's why instead of going for the traditional kind of vehicles, we're more focused on kind of platforms like yourself.
I see. Interesting. So you've mentioned quite a few things here, all of which interest me quite a lot. So I'm really keen to sort of speak about them in a bit more detail, if that's okay with you. So you mentioned that applied AI is one of the things that your company focuses on. I'm really keen, and I'm sure the audience is too, as to your thoughts around application of AI / ML techniques to financial engineering projects, such as what you're engaged in. I'd really be keen to hear more about your journey in the application of AI, and if you're up for it, any insights as to how you're going about applying statistical learning to financial engineering, as you say you are.
So basically, it has to be always supporting an idea. So the better the idea, the less robust. I mean, the better it's going to be when you apply the techniques. So the origin of everything is simple. It's an idea who makes sense and is sustainable over time. And then to apply on that with any sort for the unsupervised learning to obviously to understand how the features of the data we have. We use the only price data right now. I'm talking about because we offer several products. And apart from what we do in Darwinex, we do as well white label products for institutions. Yeah. So I'm talking about the products that we have Darwinex, we use price data, open, high, low, close. We use in 1 minute.
I see. So is that very short-term statistical anomalies or price-driven, I suppose, given that you're using just price data? Is that sort of the focus at the present time?
So the idea is to build.
That's your data source.
Yeah, we build daily. We trade on daily using the 1 minute to build the daily candle. So we use 1 minute candles to build 1 day candle.
I see, right. So essentially you're using a finer precision data source. So you're using a large volume of minute-wise data, as you say, but your end goal is to be able to generate signals on a longer time frame, daily in this case.
Exactly, but we have the info of the, I mean, the shorter the periods of your info, as you said, the more you can do with it, because you can build a day that starts at the standard time, or you can build a day that starts every minute. So every minute you have 24 hours day. You have so many days in a day. Every 24 hours you have so many days as possible. So you can study each one of those independently. So it gives you a lot of flexibility in terms of what you want to do. Yeah. So that's how. Going back to the origin, as I said, you asked for instances, open, high, low, close prices of liquid instruments. So the first thing we look at is the universe. So we try to trade the most liquid instruments possible to avoid all the slippage and all the stuff and the liquidity that can affect. It's hard enough to make money with a system.
Sure. Yes.
Stuff like that. So for the because we trade market in and out, obviously. We used to trade limit, but it makes more sense now to do it. We have a platform that works fine and so on. It makes sense to do on market. I mean, that's what we do. But the main idea on that is it's a pattern recognition. What we do is basically, as I said, we started this in 2008. We've been going on for 12 years. Yeah, because it was applied the strategies that we're running with you guys. I mean, one of them was running almost 100 million. And so it's been tested with volume. That's my point. Okay? Because sometimes unicorn strategies are very good with not much volume, but then they're not so efficient when you start applying volume, which is one of the main things you have to take into account as well in the info I was telling you earlier. So it's not only the 1 minute, but also the volume that you can trade at each specific time.
I see. Understood.
You can calculate if I trade at this time. Let's say I trade at 5 p.m. every day. I could work out how much volume I could do if all my systems were long at 5 p.m. What's the volume on that day? What's the volume on Friday? What's the volume on Monday? So you have kind of pre-study how the volume is going to affect you. So that is very helpful because you might have constraints in volume with with X instruments. So you may need to increase the number of instruments that you apply just before even you get to that point. So it helps you as well going around and what you do. Yeah. So.
And speaking of volume, so you mentioned asset universe and volume. So tell me a bit more about if you permit me to ask, of course, the asset universe that you primarily target with your various Darwins, for instance, ZVQ, for instance. Is there a particular asset universe, a particular asset class that you're going for? Is it a more diverse array of asset classes or assets, a diversified array of assets? Tell me a bit more about that, just for the benefit of the audience. I'm sure they're keen on, when you maintained a very long track record. So with that come challenges over time, and you've got a lot of learning to offer here.
Obviously, as it's obvious that the more the instruments you can use, the better. In the ZVQ, we're just using FX because that's the strategy we wanted to apply. As I said, it's been going on for a long while. Over there, we trade. I mean, some of the main crosses like euro, the dollar, sterling, Aussie dollar, Kiwi
primarily
dollar.
The majors, is it?
Yeah, the majors, only the majors, but not all of them.
Okay.
But just some of them, and then the cross about all the crosses some of the crosses between them, and then we also split not only the instruments but in the entrance time. So for example, we apply a layering. So if we're gonna trade 10,000 on the euro dollar, we split it in 10 different times during the day. It's like 10 different, although it's the same instrument, because at the end of the day, an instrument is just a number. I don't care what the asset class is. I don't even care what an asset class is. Everything can only go up and down, and everything is risk on, risk off, regardless of the asset class you look at. All of them are risk on, risk off. They all have a specific behavior regarding the volume. So if you take it to the extreme, let's say to that level, then asset class don't exist. You only have instruments that go up and down. You have the volume of the instruments. If the volume is high enough, then you can trade it. And when you trade it, you're going to analyze how it behaves and how uncorrelated to the other one. If they're very correlated, they might be different asset classes, but being very highly correlated. They might be in the same asset class and uncorrelated to each other. So obviously, the asset class is important because you meant to have a high correlation with the same asset class, but it's not always the case. So, and also, you can avoid that as well in a way by doing layering. So you can split your entrance in different times of the day, and each time of the day. So the euro dollar at 10 a.m. will have different parameters from the euro dollar. Well, yeah.
And speaking of parameters, is there any particular rationale that determines those parameters for you? Those at, for instance, if you're targeting a particular asset mix over different times of day.
No, well, because we've been trading so long with these currencies, we know kind of how they work. But basically, the volume reduces quite a lot after the London close, as you know.
Yes.
The US market, well, it's okay until the US market is closed and New York.
I see. Okay, now I understand better. Okay.
We don't trade overnight, for example. I mean, we don't trade 5 in the morning, although we might do it, but we're not doing it because we kind of trading. This layering I told you about starts at 8, 9 in the morning, so we kind of try to focus on using the days with more liquid. I mean, the times of the day with the high liquidity, and then once you've done that and you've selected the range of time in which you're going to trade, then and you do the pattern recognition, you do the backtest set, which originally was 2000 and 2008. Sorry, so those 8 years were the base of the system, because they kind of summarized almost every market apart from an intervened market from 2000 2008, where you had long short equity, long short credit, long short interest rates. I mean, high and low hawkish and dovish periods. We had bullish and lateral commodities. We have not had a down market in commodities yet. So we kind of had a mixture of almost any kind of market. We high vol, low vol, the dot-com bubble, and so on. Obviously, afterwards, we keep incorporating the new info to all the backtest, all the info from 2000. So we run the system on a daily basis like if it was a backtest. So same as at the beginning, and reality has to match the backtest that we started.
Would I be correct to say that's some sort of optimization process that you're following?
Well, it's a way of letting the system adapt to the new prices, the new.
I see.
Because
understood.
If we coming from a very high volatility period, and we're coming into a new volatility period, how are you going to know that? Because the new prices you're getting are less volatile. So obviously there is a period in which the system has to adapt from one period to the other, and also when I mean adapt, because the system is alive, let's say it changes as well the parameters in terms of the take profit, the stop loss. So everything's kind of, especially the take profit adapts to the environment. So in a higher volatility environment, we will demand higher take profit. In a lower volatility environment, we will demand a lower take profit. Obviously, when that changes on the volatility range, the system obviously doesn't know. It's not going to be right every day. You might need to adapt to it, but then it adapts and it recovers. So as you can see if you can look at, we have two Darwins. One is the ZVQ, and the other one is the YIR. The YIR is a mixture of FX, so it's the same strategy as on the ZVQ. 50% of the portfolio, the other 50% is using equity indexes, for equity indexes.
Which would those be?
The mini S&P future,
Mm-hmm.
the mini Nasdaq future, the Euro stocks, and DAX. So
I see. Okay. So it's more diversified than ZVQ.
Sorry, say that again.
So it's following a more diversified approach to ZVQ in terms of asset selection.
Yeah, in terms of asset class, yeah. As you said, as I said, so yeah, in there we're looking for uncorrelation between the two asset classes, as you mentioned.
Mm-hmm.
But my point was that obviously you can do that, and it's great. But the thing you can try to get uncorrelation within the same asset class. So it's not the CTA approach in which is looking for the uncorrelation from the different asset classes.
Mm-hmm.
We like to use two approaches. One is looking for uncorrelation in general. I mean, period. I don't care what the asset class is.
Mm-hmm.
For you, it's a number that goes up and down. And then on top of that, you can also do the more traditional approach of on top of that, try to incorporate different asset classes. Yeah? So it's both ways. It's not that just that we don't believe it's only one way of doing it. So as the system will adapt, will incorporate the new info, the new price info that for you,
mm-hmm.
Which will be changing slowly, but changing or adapting the whole 20 years of info that we have installed in terms of recovery. So that's why if you look at our strategy, usually it's quite stable.
Mm-hmm.
You get quite a lot of data. We actually write around 66% of the days and around 65% of the weeks. And you look at on the stats on the platform, which is very good in terms of stats,
Mm-hmm.
you will see how our product is pretty stable over a long time. It's around 65% of the weeks and of the days it makes money. But if you look at then usually we have a drawdown, and usually the recovery tends to be a V-shape. So it tends to be a quite steep recovery.
Mm-hmm.
Well, and that's the nature of the product, as I mentioned earlier. The system knows we are in a specific volatility environment here, and it's adapting the parameters to that. But this is a sudden change.
Interesting.
When it's a sudden change, then obviously the system needs to know that we're in a new environment. So at the beginning, it might not always get a drawdown when that's the case, but it tends to be in those cases. Obviously, the system thinks we're in a high volatility or in a low volatility period, and then somebody changes. Then until the system changes or adapts the parameters, it might be a while. So that's usually you get a drawdown, and then the recovery, and then the system continues. So that's always the way. So whenever we have a drawdown, it's not just it's not something that we look for, obviously. You cannot.
Sure, inevitable at points.
Exactly. There's no way you can not having any sort of drawdown. But,
sure.
But the thing is, in a product, it's kind of something innate. It's like a natural way of working in terms of how the product. So it's the way in which we check whether or not the system is working properly is not to do with whether or not it's making money. It's to do if it's making money when it should be making money.
So on the subject of volatility and market dynamics, market regimes over time, what was your experience with obviously COVID? I'm very keen to hear your thoughts on how you and your team navigated the COVID crisis as it evolved, as regards the Darwin.
Okay. Well, I'm going to give you my view. Actually, COVID is exactly the same as it's just as I said. At the end of the day, if you look at the volatility, it can be risk on, risk off. The higher the vol, the lower the risk assets. I mean, the worse they do. So you're going to have equity down, carry trade down, government bonds usually up. Credit spreads widening, and so on when you get risk on. So at the end of the day, you can argue, as I told you, going back that the dot-com bubble, Lehman Brothers is dot-com bubble times 3. I mean, we have COVID. It's been slightly more than the Lehman Brothers. The thing is just been the speed of the movement. Much quicker, much quicker. The quickest in history, obviously, for such a movement that we have in COVID. So the way the system is that the drawdown, the movement that you may have on the product will depend on the volatility. But then the system recovers. It's the same. It's just the way the system is set up is that we implemented a stop loss now on the strategies, like a fixed stop loss to avoid try to avoid the movement. But if you, let's say, to take the product and leave it without a stop loss, what's going to happen is going to have a drawdown that is going to be according to the movement, and then a recovery that's going to be according to the movement. So you're going to have a steeper drawdown with a much steeper recovery. So at the end of the day, you can presume that the movement in volatility is always the same. You're in a cave, you don't know what's going on outside, you don't know if that's because of COVID or a war or Trump or whatever. You have no idea. All you see is the volatility going up or going down.
I see. Anything else you'd like to share? I mean, I think a lot of your exposure is in ZVQ, is it, primarily? And then you have another Darwin called YIR that is more diversified than ZVQ, which is primarily FX, as you mentioned. So were these dynamics handled the same in terms of COVID and its impact on markets between YIR and ZVQ? Or are there any fundamental differences in the way those two strategy portfolios operate? That
exactly the same approach on both, as I said, because we used the difference is obviously on FX, for example, the movement was more in March than in February. I mean, more compared to equity, where most of the movement was in February. Yeah, so that's kind of the dynamics of the different asset classes. If you look at FX, it wasn't so such a strong at all. It was more March and April when the market in equity had recovered a little bit. It was more stable. So yeah, but the way the approach on both is the same. It's the same thing. Is a pattern recognition. In this case, we're looking for turning points. We're looking for, the system is looking for small corrections when the market is going up or go down X amount of time. And that's the same approach on both. So if you identify instruments that have that behavior, you apply the instruments in the way we described earlier, and you just trying to you keep feeding the system to try to adapt to the environment. That's how you get the long term. Because on the ZVQ, for example, we started in Real in 2017 with a Darwin called December 2017 in Darwinex with a Darwin called WKQ, and then we changed to ZVQ for technical reasons. I can't remember why, but it's exactly the same strategy. So the real track record on Darwinex is from December 2017, so it's almost 3 years. The one we see before is the carve out of the strategy used on investment funds and vehicles, as I explained earlier. Yeah,
I see, understood.
Yeah, so it's got that, and the WYR year started in April, and the in the platform. So the idea is, but the idea is the same on both ones. Is they tend to be anchorated strategy. So I will ask the audience to, if they invested on Darwinex, to check how our strategy combines to the other parts of the portfolio. Because when you add our strategy in an existing portfolio, we have a strong impact in terms of reducing volatility and drawdowns because of the uncorrelation as well, because of the stability long term. So yes, the same approach, looking for uncorrelation, looking to add value to existing portfolios of time. So I'm sure they can use the backtest tool that you have on the platform.
Yes, the Darwin backtester. That's right.
Yeah, they could do that. So I encourage people to check how it is, because that's one of the main features on Darwin platform, that you can run simulations and combine your different strategies, Darwin. So that's the idea, and that's one of the main focus on our one, to help improving existing portfolio.
Thank you for sharing so much detail. I really appreciate it. I'm sure the listeners do too. So we were on the subject of platforms earlier on. Is there any particular research environment you use for all the R&D that goes into your Darwins? Is there a particular platform of choice? Are you trading via APIs, or is it MetaTrader or something else? Could you shed some more light on your actual operating process, platforms, data sources? What do you go about using? For instance, like for me, for instance, MetaTrader is a bridge. And very recently, we've launched Interactive Brokers, which is in phase 1. So I fully intend on leveraging the API presence there. But for me, the focus is development of any strategy in external programming languages, and then using MetaTrader as a bridge to take the signal to market. In your case, what is the equivalent in your case? Are you trading primarily in MetaTrader, or is there an external R&D environment and then you're sending your signal through to market? Just if you could shed some light on that.
No, we use Python. We have everything from in Python. So and then we connect to the, depending on the, one of the Darwin's we use in Fix, and the other one we use in the MetaTrader API too. And then we adapt. We've done it in the past as well with TradeStation APIs, and the same with Interactive as well. With them on APIs. So yeah, so the idea is once we have the everything in Python, we just try to adapt to the, you know, the different platforms have different approaches. Yeah. So whether it's we've been doing on both Fix or API directly, and then our data sources are obviously historically it's been Bloomberg or Reuters, some of the main ones. That's the company, but obviously we're using the some of the platforms as well, the Darwinex info that we get, and we keep feeding the with your info, and then keeping as well building the bars on that one. Yeah, and then we have everything. We have it in work through DigitalOcean, Dockers, and so everything we have in the company is actually beautiful. Let's say Mongo for the databases, and so that's the structure on the product. And we also have as well the info available on Telegram, so we can check every position on anything we want to check on the strategy, and we can check real time through Telegram.
Very cool. So it sounds like an automated environment from research all the way through to execution and day-to-day sort of monitoring, which is quite nice to hear. It's always a pleasure to hear Darwin providers who have environments of this nature where they're leveraging the goods of each tech stack and bringing it all together into an environment where the research is served best by the environment that is required for it. In your case, you're doing all your R&D in Python, and then the appropriate bridge, which in your case is Fix for one of your Darwins, I believe, to take any produced alpha to market. So very cool. Thank you for shedding light on that. Always good for the audience as well to hear that it is indeed possible with the Darwinex stack to amalgamate different technologies to achieve your outcomes. So is there now you've had like a lot of you have obviously a very long track record. So is there any sort of word of advice you'd offer algorithmic traders who are listening to this, regardless of their years in the field or level of expertise, anything that sort of stands out in your experience over time in dealing with the financial markets? Is there any sort of nuggets of advice that you'd offer?
Well, I don't know if I'm not entitled to give advice.
Well, advice is probably the wrong word in the financial context. Insights, I believe, yes.
Okay, my experience. Well, basically, I think one of the key things with the systems is how do you know when a system is not working anymore? That's the main thing. That's fun because I'm also a teacher as well, and we have schools as my colleagues, and we've been teaching for a while. So my approach, and that's personal, that's the way I see it. People have to agree with that, but that's the way I see it. To me, it's not relevant if a system makes money or loses money, because anyone in the street, your grandma won't be able to do a system that only loses money. There's no way he won't be able to.
Yes, true.
You're not going to short that system. So anyone in the street will do a system that will make money at some point and will lose money at some point. So that's, to me, that doesn't mean anything. Someone who makes money with the system, well, okay, yeah, depending on the period, you will. The important is obviously that you make more money than you lose, which is obvious, but also the check to see if the system works or not, or to keep it or stay with it, to stick with it when you have doubts, which that's part of the cycle trading, which is obviously main part. I also teach cycle trading, which is one of the main things. The most difficult part of what we do is, in my point, is that if the system should be making money in a specific period, should lose money in a specific period, every system, and you should identify which periods are good and which periods are bad for your system. So if your system is losing money in a bad period, everything is good. Stay with it. If it's losing money in an environment where it should be making money, there's something wrong. So that, to me, that's the key. Because, as I said, it's always so difficult to know, well, okay, well, it's never had a drawdown like this. Yeah, so well, it could be perfectly normal that the drawdown now is bigger because the movement is bigger. Nothing wrong with this. Some people will say, well, it's never had a drawdown like that, so it's not working anymore. So that's my approach to it. So that's about everything I dare to say. Okay.
No, very cool. Thank you for sharing. I'm sure everybody appreciates the depth into which you've gone today. We've talked a lot about your R&D process, all the way from applications of different learning techniques to data sources, precision of data sources, and the use of granular data in your case to arrive at daily signal generation as opposed to trading finer precision. You shed some light on the fact that you're conducting all your research and development in external programming languages like Python, and leveraging different technology to take that signal to market. In your case, Python through to fix, and then fix through to market. And then you also shared some very useful advice, guidance based on experience on how to go about navigating the realms of, well, when does one know whether a strategy is still robust or not, or is the strategy robust at all? When can we determine, how should we go about determining whether a strategy is failing or due to fail, and things like that. So I think in summary, it's been a very nice conversation. Thank you for shedding light on all those things in a lot of detail, and hope to see you again in future for when we have the next one of these, which will be in a few months' time, I believe. Right now, everybody's in some interesting dynamics with COVID, and dynamics that affect our environment, but we're also creating some interesting new dynamics in the markets for us all to backtest in future and incorporate in our research. So thank you very much for myself and all my teammates here at Darwinex for your time, and look forward to speaking to you again very soon.
Okay. Thank you very much for the invitation. I hope people don't fall asleep too much.
No. Well, the right people will stay awake. So let's put it that way.
All right. Okay.
The right people always stay awake.
Okay. Let's start that. I shout a lot anyway. So thank you very much for your invitation.
Thank you, Narciso. See you again next time.
Okay. You take care, man.
Take care.